friends, how are you? This is Dr. A B JENA, Senior Assistant Professor, PG Department of Business Management. Once again, I am welcoming to all of you to this video lecture. By blessings of the God, you are doing well. Without delay, we will start our discussion. So once again, on the request of my student friends, I have prepared these videos, and today we are going to discuss the important 12 concepts or the terms so far as the commerce management, PMR economics subjects are concerned. Okay, so without delay, we will start our discussion. This is the part 2 of the terms and the concept are concerned. So I have collected this information from the books and from the internet. So without delay, we will start our discussion, dear friends. Okay, before discussion, kindly take the screenshot. Yes, so first one is that is the leverage. What is the meaning of a leverage concept or the term? And the leverage, it is an investment strategy. So it's a leverage means it is an investment strategy by using the borrowed money or the borrowed fund by issuing the securities, specifically the various financial instruments. So financial instruments, the financial instruments, so these are financial instruments are also known as financial assets. So the examples of financial instruments, so these are the bond, debentures, shares, okay, the commercial paper, certificate deposits, like, so these are the examples of financial instruments, okay, to increase the potential return from the investments. So it is the meaning of leverage. Once again, I am repeating, dear friends. Leverage, it is a financial strategy by using the borrowed money, especially the various financial instruments, to increase the potential return from the investments. So it's the ultimate aim of a business or a firm to increase the profitability position of the business, as well as to enhance the market price of the shares, as well as to enhance or to increase the value of the firm. Come to the second one concept, it's the beta. Beta, what is this? Beta is an index. Beta is an index to measure the systematic risk, of stocks with regard to the return from the stocks or the portfolio. Beta, so that's why beta is very, very vital. Once again, I am repeating it. It is an index to measure the systematic risks of stocks with regard to the return from the stocks or the portfolio. Then, so far as the risk is there, the systematic risks. So, dear friends, I have already posted one video. So, what are the different types of risks and what is the basic difference between the systematic risks and the unsystematic risks. Once again, so we will discuss what is the meaning of systematic risk. Systematic risk, it's also known as that is the market risk, and the business or individual cannot control over it, and accordingly, so you have to just formulate the strategy and you have to develop the planning. So how the systematic risks will be reduced or how the systematic risks will be avoided. Okay, so systematic risks, the risks that are uncontrollable. So that's why, so it's the beyond the control of a firm or corporate or business organization, even beyond the control of an individual. And the systematic risks will arise out of the external factors. So these are the external factors. It may be the political factors, or it may be the economic factors, it may be the socio-cultural factors, it may be the IT, information technology factors. Some examples of systematic risks are inflation. We cannot control over it. Then if the poverty and the COVID-19 situation, more or less we have already been affected with COVID-19, that is in physically, mentally, economically. Then if there will be the war, what is the situation in the case of Russia and Ukraine? And now, what is the situation in Sri Lanka? Dear friends, just you recall what is the situation right now in our neighbor country Sri Lanka. Similarly, what is the situation in that is the poverty and other economic conditions of Pakistan. Yes, so that's why the systematic risk So risks that are uncontrollable in nature and arises out of the external factors such as that is the political, economic and other factors. The some examples, the popular examples or the good examples of systematic risks are inflation, poverty, COVID-19, corona, war, etc. Come to the second one, next one, fourth one concept, it's the unsystematic risks. So unsystematic risks, which is these are out of the internal factors and easily by taking the very good or the planning or strategy you can avoid or you can even minimize the unsystematic risks. What is this? The risks are uncontrollable in nature and arise out of the organization or internal factors. Examples of unsystematic risks: higher operational cost, you can reduce or you can avoid or you can control. Then labor turnover, you can also control it. Overhead expenses, overhead cost or expenses, etc. So these are the very good examples of the unsystematic risk. So it's in the hand of the organization as well as the individual can control the unsystematic risk. Yes, efficiency and effectiveness. Efficiency and effectiveness. So these are, we have to clear about the efficiency. Just you have to remember what is this DTR. DTR, you have to remember efficiency means doing things right. So efficiency is the process or it involves with doing the things in the right manner. So example, proper utilization of resources. So human resources, non-human resources, or financial resources, non-financial resources. So it's the responsibility of the organization can utilize it properly and perfectly in order to get the 100% results. So dear friends, now you are clear what is the meaning of efficiency. Efficiency, once again I am repeating, doing things rightly. D stands for doing, T stands for things, R stands for right. So efficiency is all about the proper utilization of resources. What are the resources are being used in a firm or organization? If effectiveness is the broader term as compared to the efficiency. Just you have to remember what is this DRT. D stands for doing, R stands for right, T stands for things. Effectiveness is all about the achievement or attainment of organizational objectives. Dear friends, now you are clear. Once I am repeating, efficiency means doing things right, DTR, proper utilization of resources. Effectiveness, doing right things, DRT. And effectiveness is all about the achievement of organizational objectives. Both the efficiency and the effectiveness both are complementary and supplementary with each other. Yes, bond. Bond, what is this? Bond, it is a promissory note. Promissory note in negotiable instrument. In negotiable instruments, so these are the popular instruments: bills of exchange, promissory notes, check. In another separate video, what is the basic difference between check and a promissory note, we will discuss later. Bond, it is a promissory note which is issued by a company to raise the long-term debt. And the bondholder will get what? The fixed rate of interest. After the certain time period, a company has to repay the amount to the bondholder. Then bond dividend. With regard to this, I have already posted one video. What is the meaning of a dividend and what are the different forms of or types of dividend? Yes, bond dividend. What is this? The dividend which is paid. The dividend which is paid by a company to shareholders in the form of a bond. If a company has no sufficient working capital, I mean the cash. So in this situation, company will pay the reward in the reward. Reward means dividend to the shareholders in the form of a dividend. Sorry, in the form of a bond. Okay. Next, it's a very vital business risks. Business risks. What is this? business risks when a firm or a business or company is unable to pay the fixed obligations. Fixed obligation means suppose interest to the bondholder or to the debenture holder or to the creditor. So in this situation, if the company is bearing the losses, in this situation, business or company will face the business risk. When, once again I am repeating, business risk, it is or when a firm is unable to pay the fixed obligation. Fixed obligation means that the interest to the bondholder, to the debenture holder, and other expenses. Then the financial risk, what is this? When a firm is unable to repay the debt obligations. Financial risk when a firm is unable to repay the fixed obligation, means the payment to the debenture holder, to the bondholder, or to the security holder. Yes, if there will be the market risk, there will be that is the inflation, market risk, COVID-19 war. So in this situation, a firm will be unable to earn more and more return from the investment. So in this situation, the business will face what? The financial risk. Then the stock exchange. Stock exchange, what is this? Stock exchange, ACE stands for stock exchange. So stock exchange in an organized market. Organized market means the rules and the regulations are there. So far as in India stock exchange is concerned, who is the regulator, who is the leader? SEBI, Securities and Exchange Board of India is the regulator. In popular stock exchange in India, that is the BSE, Bombay Stock Exchange, NSE, National Stock Exchange. So they are BSE and NSE, so they are the organized market for the purpose or for buying and selling the securities. Securities, I mean the shares or the stocks will be sold and purchased in where? The stock exchange. It may be in where? The BSE or NSE. BSE it's the Bombay Stock Exchange, NSE it's the National Stock Exchange. So through the stock broker you can purchase as well as you can sell the securities. Last but not the least, you see the EVA. What is the meaning of EVA? EVA, it stands for economic value added. EVA, it's also known as, that is economic profit. It's also known as, what is this? Economic profit. Economic profit, it's also known as economic profit. So EVA is a financial performance method. EVA is a financial performance method to calculate or to measure the true economic profit. So EVA is also known as, what is this? The economic profit of a business or the corporation, and EVA is treated as or serve as the indicator of the profitability of projects undertaken. And here the EVA, the project means that the investment by a business or by a firm, where the project should create or the project should give more returns over the cost of a capital. Cost of a capital, when in the case of capitalization, a firm or business will issue the shares and to the shareholders, business has to or company has to pay the dividend. Similarly, suppose a company will issue the debenture to the debenture holder, a company must pay the fixed rate of interest. So these are the cost of capital. So cost of capital is nothing. What is this? So cost of capital is nothing but that is the expected rate of return to justify the investment, the cost of capital. So always, what is this? The projects should create or should be more than the cost of capital. So these are today's discussion. So dear friends, I am 100% hopeful that you have learned a lot, and this discussion will be very, very useful for the competitive examination as well as in also in your academic examination. Also this will be helpful to the UGC NET and JRF as well as the other lectureship examinations. point of view. So once again, thanks a lot to all of you. Also, I will request to all of you, kindly you share it, kindly you forward it, kindly you subscribe it, and please don't forget to just press your bell icon so that you will get the new video. So once again, thanks a lot to